There's a reason why so many people are pulling their money out of banks right now and instead putting them in money market funds. Banks are falling like dominoes right now, with now PAC West Bank Corp down 53% in just after hours trading. Western Alliance Bank Corp down 23% in after hours trading. Comerica down 9% in after hours trading. Not to mention the behemoths that have already fallen, like First Republic Bank and Silicon Valley Bank. And money market funds are attracting record net inflows. The reason why, as we'll see, is that banks offer more risk and less reward, while money market funds actually right now have far less risk and offer a much better return.
First, I'd like to tell you about today's sponsor, I Trust Capital. Today, people are concerned about the purchasing power of their dollars being eroded due to inflation. They're concerned about the returns they're getting on their traditional portfolios, things like stocks and bonds. Many people want to be able to purchase investments that will preserve their purchasing power, things like gold, silver, Bitcoin, ways to store the value of your money without being exposed to the dollar. What's the problem with this? The problem is that most people have most of their wealth in their 401ks, their employer's retirement accounts. And these accounts do not allow people to buy gold, silver, or Bitcoin. Some of them allow access to ETFs that have exposure to these prices. But number one, you're introducing many layers of counterparty risk. And number two, you don't actually own the asset itself. That's where I Trust Capital comes in. I Trust Capital allows you to open up actual retirement accounts, IRAs, traditional and Roth. You can even roll over funds from a previous employer's retirement account to fund this. You can buy gold, you can buy silver, you can buy Bitcoin and even other cryptocurrencies with I Trust Capital. And if you sign up with my link in the description below, you'll get $100 worth of Bitcoin as a sign-up bonus for opening the account.
So let's talk about the risk involved first. When you give your money to a bank, you will open yourself up to multiple levels of counterparty risk. Counterparty risk is simply the risk that some other person, some other party doesn't fulfill their end of the bargain, their obligation to you. And so when you give your money to the bank, you are now a creditor to the bank. That is a loan. You have lent those dollars to the bank. Now, the bank then goes out and does whatever they want to do with those dollars. They normally buy assets like treasuries. They loan those dollars out to somebody else. This means for you to be able to get your dollars back, you are now opened up to at least two levels of counterparty risk. You are opening yourself up to the risk that the bank can't pay you back, that the bank fails, but you're also opening yourself up to the risk that whoever the bank loaned the money to can't pay your dollars back to the bank so that the bank can give them back to you. Most of the time, the bank is going to be loaning those dollars to US government in the form of buying treasuries. But even then, as we're seeing with all the talk about the debt ceiling right now, with June 1st being labeled the new X date where the United States would default if the debt ceiling is not raised. Now, the probability that Congress will actually allow a default to happen is very low, but it's not zero. And so even if the bank is doing the most risk-free thing they can with your dollars, there's still multiple levels of counterparty risk there. But what about a money market fund? Because wouldn't a money market fund also carry a bunch of counterparty risk just like a bank? Well, first of all, I need to specify that I'm talking here about money market funds that you get through a brokerage account. Something like Vanguard, Schwab, or Fidelity. In this case, the place that you choose to have your brokerage account, they're operating as a broker. So you are not lending your money to Fidelity, you are holding it, they are custodying it for you, but it's not a loan, you're not a creditor. You are choosing the asset to buy, custodied by the broker. This means if you put your money in a brokerage account and you buy a stock like Apple or Amazon or an ETF or a mutual fund, and then that brokerage firm fails, Schwab goes under, Fidelity goes under, Vanguard goes under, whatever the company is, they fail, you maintain the ownership of the assets that you bought. They're your assets. You own them. You are an owner, not a lender, not a creditor. Those assets then, your stocks will just move to somebody else, whoever absorbs those accounts. So let's say Fidelity fails. all those accounts will just move to somewhere else, like let's say Vanguard, and you maintain ownership of those stocks. Just now you maintain the ownership of those stocks through Vanguard instead of Fidelity. There's no insurance needed. There's no bailout needed. You own those stocks, not Fidelity, so it doesn't matter if Fidelity fails. And so if the asset that you choose to buy is a money market fund, then you are putting your money into something similar to a mutual fund that buys stocks, except with a money market fund, they're buying other things. Things like keeping it in cash, buying US government securities, and or reverse repo agreements. And so there's certainly counterparty risk here, no doubt about that. But when determining what to do with your cash, because everybody needs some cash, the question is, how do I reduce my counterparty risk? Because you can't eliminate it. But I want to point out something to you that you may have noticed when I was reading off the things that many money market funds will invest in. Repurchase agreements. That's right. Remember this chart? The reverse repo facility at the Federal Reserve with over $2 trillion in it since June of 2022. That's from money market funds. And so you put your cash in a money market fund, that money market turns around, hands that cash to the Federal Reserve, and right now gets paid over 5% on that risk-free. And when I say risk-free, I mean it, because when you give your money to the government, you buy a treasury and you loan it to Uncle Sam, there's less risk there than loaning it to a corporation that could file for bankruptcy, that might fail, that might not make it, but there's still risk there that the Democrats and the Republicans both get too stubborn and they want the other side to appear weak and they want the other side to give in, and neither one of them does, and then suddenly default occurs. Is it highly likely? No. Is it possible? Absolutely. But any money that is in the reverse repo facility is at the Federal Reserve. At the Federal Reserve, they just click a few buttons and that money gets printed and sent to whoever deposits money in the reverse repo facility at a rate of now 5.05% annualized. They're the only entity that just gets to print money. There's no default risk here. And this is exactly where many money market funds are parking their cash right now. No debt ceiling issue, no default risk. In terms of fiat and in terms of savings and cash, this is as risk-free as you can get. And you and I can't park our funds directly at the reverse repo facility, but we can do it indirectly through a money market fund. All right, now let's talk about the reward, because we've seen clearly now that banks carry a much higher risk than money market funds do. But does that lower risk mean that money market funds have less of a reward? And are banks still worth it considering the risk-adjusted return? Well, with a bank, you are basically funding their entire operation. Remember, when you put your money in your bank account, you are a lender, you're a creditor to the bank, and then they go do whatever they want with those dollars. You're not putting money in that account and then choosing how to invest it with an investment you're purchasing yourself. You're just loaning the bank some money. And they've got expensive operations. They've got buildings in prime real estate for people to walk into. They've got employees. They've got staff. They've got websites. They've got cybersecurity issues. They've got lending and they've got investing. And most importantly, they have some pretty important executives that wear some pretty expensive suits and have some nice offices in New York, and they've got to pay for all of that. Those very important people that are getting paid a ton of money to do very important jobs, they've got to keep the lights on for those people. At the end of the day, all that means that because they have such high expenses, there's going to be a lot left over that they have the ability to pass back to you. This is why at Chase, you get a measly 0.01% right now, no matter your balance size. And that's probably not going to get better anytime soon, because for years, banks were taking your money and they were buying investments like the United States 10-year Treasury at record low rock bottom rates. And so they're going to have to wait 5 years, 6 years, 7 years, 8 years from now before all of those old loans start to mature and they can reinvest them in higher yielding securities. And so on top of all their expenses, their income from those investments is a lot lower than what is available right now. Now you might be thinking, well, aren't money market funds in the exact same position? And the answer is no. Money market funds, at least the ones that I'm discussing here, are not locking their funds up in securities that won't mature for 5 to 10 years. They're only investing in extremely short-term debt. Case in point, the reverse repo facility, which is overnight, or things like the United States 1-month government bond or T-bills. And so this whole time while rates have been climbing, money market funds have had all their investments mature, get paid back, and then they can roll them into the new investments that have a higher yield. And so most money market funds right now are earning a much higher yield on all their assets than banks are right now. On top of that, they have way lower expenses. Money market funds are simply a mutual fund. So you might have one person, 2 people in there managing the rolling over of the assets, the buying of new assets, and the redemption of some assets in order to meet any withdrawal requests from the fund. Very low cost operations. This is why the expense ratio of money market funds is so low at under 0.5% for most of them. Expense ratio meaning of all the dollars we take in, here's the cut that we have to take to have our profits and to keep our operations rolling. Everything else we pass back to you as your profit. Vanguard has one that's just 0.11%, which is why the yield can be 4.5% at Fidelity, 4.77% at Vanguard, and 4.69% at Schwab. These operate just like mutual funds, and so you can purchase this money market fund and that trade will settle in one business day. And then if you need to get your money out, you sell it just like a mutual fund and your trade will settle in one business day. And so yes, they're a little bit less liquid than something like a checking account or a savings account where you can move the money in and out of the account same day, because you have to actually make a trade. You have to buy these and then you have to sell them. So it might add 1 day or 2 days between when you can actually access the funds or move the funds out. If you have a brokerage account at Fidelity, one of my favorite funds that they have is the Fidelity Government Money Market Fund, SPAXX. If you have your money with Vanguard, I like their Vanguard Federal Money Market Fund, VMFXX. And if you have your money with Schwab, I like their Value Advantage Money Fund, symbol SWVXX. Of course, you know the drill. I'm not a financial advisor and this is not a recommendation, but hopefully you learned some valuable information and you're able to make some better choices with where you park your cash. And finally, if you'd like to learn more about how to grow and protect your wealth, join Heresy Financial University, where you'll get access to my courses that are in-depth guides on things ranging from fundamental analysis to portfolio allocation to professional options trading strategies. Link is in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.